What's an illusion and what's real? Hi, everyone. I'm Maggie Lake, and I'm talking markets today with George Noble, head of Noble Capital Advisors. Hi, George. Welcome to the show.
Hi, Maggie. Glad to be here.
Glad to have you here. And I feel like sometimes I'm lucky with the timing. So you have traded through market booms, busts, lots of geopolitical turmoil dating all the way back to your time running Fidelity's overseas fund. So I'm glad that we're able to lean into some of that experience today because, of course, we're coming in from a weekend, huge amount of news breaking, U.S. bombing Iran over the weekend. We have retaliation today from Iran, Israel and Iran exchanging as well. Iran targeting a U.S. military base. And against the backdrop, some people were surprised to see the markets have been calm all day and, in fact, rallied in the afternoon, even as that Iran strike was being announced. So I'm just kind of curious. It's one thing to not see a sell-off. It's another thing to actually see stocks rally, oil pull back. What do you think is driving this? Is it just sort of sell the news or buy the news? How do you categorize this?
Well, the first thing I'd say, and I think I sent this over to you, is screenwriter William Goldman said, "Nobody knows nothing." One of the things I've learned in 40 some odd years is fade the hot takes. And when I was younger, I couldn't resist. Everyone loves narrative, and the narrative is constantly shifting. Everyone loves stories, Maggie,
Yeah.
And it's so hard to stick to your process. I mean, the number of times I've violated it, it's embarrassing, but you have to have a process. And it's become a national sport. I mean, okay, so the last few days it's all about Israel, and we can talk about that. Before that, it was all about the tariffs, all right?
Mhm.
And nobody knows, not even Trump knows, okay, or knew. He's changing his mind every other day. And I don't want to make this political. It's just reality of what was happening. As Jay Pulaski said at our conference a couple of weeks ago, his superpower is to ignore Donald Trump. It sounds silly, but it's actually true because you can just get distracted so easily. Especially if you get caught up in the world of X. I'm big on Twitter. I keep calling it Twitter. It'll always be Twitter in my mind. The Furus, as they call them. Okay, everyone's. I joke about it. People were, epidemiologists, and they were shipping experts. They became tariff experts, and now nuclear experts. It's like, it doesn't stop.
It's so true because it's easy, right? All you have to do is fill in the characters in your.
Exactly.
But I think it's really. I think that's really great sort of context to put all of this in. And I think it's what's kind of unnerving people is that it is a lot of people are feeling headline fatigue. So let's look at some of the fundamentals then. And let me know what you're thinking about things. So, by the way, hi everybody on YouTube and Substack. Welcome. If you're watching live, you can ask questions. So put them in the chat. I'm sure George would love to respond to them. So when you look at sort of the bigger picture, and let's just take the U.S. economy and equities here to start. What does it feel? What do you think is going on here? Because what you'll hear is that for all the doom casting, and there's a lot of it, then you'll hear people say, wow, the U.S. economy is so resilient. We keep hearing people talk about a recession. We don't get it. We keep hearing people talk about a market crash and we don't get it. In fact, it was institutionals and hedge funds that got out, and retail just went in and bought that dip on Liberation Day, and the markets bounced all the way back. What's your sense of what's happening here on the fundamental side?
Well, before I answer that, I'll just remind everyone the economy is not the stock market, and the stock market's not the economy. And then, as I was always taught at Fidelity growing up, it's a market of stocks. So it has been a lot about positioning and narrative change. Came into the year pretty cautious. I'm a big fan of Tom McClellan, and he was drawing the analogy to the election of Reagan in 1980, where the market ran up in anticipation of Reagan's election, and then it went up a little bit more, and then promptly sold off. And we had Tom on a few months ago, back in November, whatever it was, and I found it very compelling. And that was kind of the roadmap I was running with. And the Stan Weinstein things technician always says, it's not the news, but the reaction to the news that's important. I think you just said a minute ago, buy the dream, sell the news, or the traveling's better than the arriving. Okay. So let's roll back. Let's go back to January 20th, whenever inauguration was. Trump's going to be good for stocks, blah, blah, blah. But I want to fast forward to where we are now, because reviewing history, I just want to get context, but I don't want to dwell on it.
Mm.
I think, and I'm a big fan of your show, Maggie. I watch a lot of your
Thank you.
guests, and we were headed for, in my opinion, a Liz Truss moment. If you go back a few months ago, we're both good friends with Michael Howe. He's spoken before about the need to provide more liquidity to refinance debts, et cetera, et cetera. And that's where we were heading. But I can't remember the exact date. Somewhere March, whenever it was, things broke. Or maybe it was April. I can't even remember. Time flies. You're having fun.
Yeah.
And the market was searching for the Trump put or the Powell put on stocks or bonds, and it found it. And what's happened since then? We've had all the tariff craziness, and we keep backpedaling. I don't know if we've had one deal yet so far. I haven't really been paying that close attention. Who knows? I mean, who knows what's going to wind up? I don't hold myself out as being the world's biggest expert on tariffs or the economy. But there's one thing markets can't stand, and that's uncertainty. Risk they can price. Uncertainty, no. So when you have a flat probability distribution, it's like what's going to happen as opposed to what are the odds, Maggie? If I walk across the street tonight, I'm going to be hit by a car. That insurance companies have actuarial tables. So I think what's happened is, as you mentioned, or a few minutes ago, people got bared up, following the narrative of it's the end of the world, and then things changed. And retail just kept buying relentlessly. And it was institutions that got caught out. And so you had two big uncertainties. First, you had the tariff thing, and Trump has been basically negotiating in public. I don't think the market's really paying any attention to his proclamations anymore. And then we had the whole Israel situation, the Iran situation. And it's funny, I put up a poll on X the other day. I put up two polls. One was, how soon before Israel bombs Iran, the Fordo, and it was like June 20th, June 22nd, June 31st, or not going to happen. And you'd be surprised how many people said not going to happen.
Yeah.
Then there was another question saying same thing. How long before we get a regime change? And so this goes back to my bad joke a few minutes ago about nobody knows nothing. All right. Given that, so we've had a reduction, I think, in the trade uncertainty. We don't know exactly what it's going to be, but we have some idea. And I think the Iran situation is basically done, which is bullish. Sorry.
Yeah. So if you're trying to operate off a framework, and you're reading the headlines, but you're trying to sort of stay true to some operating, system that you have. What are you paying attention to? So what is guiding you? What's the thing that you think matters the most right now?
Okay. So now we go back to our regularly scheduled programming. All right. And I'm going to go back to the whole idea of the economy and the market. I find it really interesting, I'm sure you did as well, that despite what happened in Iran, you look at how little bond yields fell and how little the dollar rose. I mean, U.S. Treasuries and U.S. dollars should be safe havens when that sort of thing happens. I think yields are down, 5 basis points on the 10-year or something like that. And the euro's back up almost to the highs now as we speak. So to me, it's very revealing. And again, we're both, vying for chairman of the Michael Howe fan club. You talk about the capital wars and money go home. I think that's still operative. I was on a call this morning with some of the folks from Goldman, and they were talking about how in the few days run up to the Israeli situation, there was some people were structurally bearish dollars and bearish bonds, and I think that's the right trade. But tactically, some folks were looking to buy call options on the dollar or call options on the bonds just to hedge their fundamental position. But that dog didn't hunt. And if the dollar and bonds are not going to rally under those conditions, to me, that's a tell. And look, life is not linear. Dollar's not going to go straight up. Bonds are not going to go straight down. I think one of the charts I sent over to you was a chart of GLD against TLT. And let me just use that to dig into the bigger framework.
Yep.
I think we are, it's an unsustainable fiscal situation. You've had various guests on your show. I don't want to be Captain Obvious here, but I think they're right. I think we are going to have a soft default. We're just going to devalue the debt like we always do. And the best way to express that is long gold versus treasuries. I joked with someone recently that, if you look at the S&P, and I'll even give them the benefit of that. Let them use the S&P. Forget about equal weight. Forget about how the indices are distorted. But if you look at the S&P, it's denominated in American pesos, i.e., a unit of account which is declining all the time. Imagine, Maggie. I mean, you're pretty sharp cookie. Imagine if we used the charts to redo the S&P in Turkish lira, it would look really great. Okay, but if we put it in Swiss francs, it wouldn't look so great. You'd say, "Wow, it's a bad looking chart." And I know you're a closet technician. So I think what's going to happen is, I mean, many have written, and I think it's probably right. There'll be some form of yield curve control, some kind of yield suppression, and I think the currency is probably going to take the hit. And so this leads into the bigger picture framework. Okay, I think U.S. equities are overvalued, and I think profit growth is slowing. But as people remind me, I used to be one of those nerdy guys that look at valuation. But if someone said, if he wants George, it doesn't work that way. It's not like the market wakes up one day and says, "Oh, we're overvalued, we're going to go down." I mean, you need a catalyst, okay? And so I think the market's expensive. I think growth is slowing. I think margins are under pressure. And again, we have to differentiate. Some sectors are doing well, others aren't. But in the main, and I think. Again, I think whereas the Mag 7 and the U.S. has been the place to be for the last 10, 15 years, I think the game is changing. I think some of the foreign markets have more scope for monetary expansion. They have more scope for fiscal expansion. So there's, I think, a big rotation going on, a global rebalancing away from the U.S. towards other markets in terms of equities. So as Yogi Berra famously said, predictions are difficult, especially about the future. But you asked, so that's what I think.
No, absolutely. And you know what's really interesting? So that we have heard that, and there's plenty of evidence to support that. And you are right about the fact that we did not see that safe haven flow into the dollar and treasuries. Now, to be fair, maybe everybody sort of calculated that this was contained and that it wasn't going to spread. Maybe that was why you didn't see a massive. But gold's up again. But when I go down that road, every once in a while, I'll get someone who says, well, yes, but there are plenty of other problems when you look elsewhere as well. And so it's a little, it's a little hard if you're trying to think, okay, where does the flow end up? Like, who's the winner if there's a capital move out of the US? And you can make an argument that it's Europe, but then you have the energy problem there. You can make an argument that it's China, but then you have their debt issues. Some people think a lot of it's off balance sheet. So we're not really, aware just what extent they're dealing with. And they have domestic consumption they can't get off the ground floor. There seems to be do you think there's an obvious winner, or is this the case that everyone just has to do a little bit better in terms of allocation for it to be a negative and a pressure on the U.S.? It doesn't mean it all goes to one other place. It can be spread around, and that's enough to cause this kind of constant, selling pressure on U.S. assets.
I think you hit the nail on the head with your latter scenario. I mean, look, if you're looking for me to tell you what a great place Europe is, and if I got a bridge, Byron Wien, God rest his soul, talked about how Europe became a great open air museum, whatever. Not happening. Okay. In fact, I had Ian Harden on. You should have him on your show. He's a great guy, absolute strategy research. And he's like, Europe, like, really? He's based in London. He doesn't want to do it, right? But Maggie, it's money that moves markets. And I think what we could say is people are so over allocated to U.S. assets, dollar-denominated assets. Positioning is so wrong. The numbers. The U.S. is about 25% of global GDP, but it's 70% of ACWI. Blah, 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 blah. So all it takes, imagine if you're a Japanese insurance company, or you're in Zurich or Geneva, a Swiss bank, and you've been killing it the last few years, because let's be honest. I mean, Mag 7 is the greatest thing going. There really was no alternative. And not only did you make money by putting money in QQQ, tell you what I'll do for you, Mag. We'll throw in a currency kicker too. So you've got the currency going with you as well. Now you look at it and it's like, whoa, wait a second. I know markets cycle back up, but if you look at the charts, in Swiss francs or in Japanese yen, and your liabilities are in Swiss francs or in Japanese yen, all of a sudden it's like, uh-oh. So all it takes is, I've heard stories, you have too. I mean, some UK pension funds, like 75% invested in the US market. Like, Come on. So I think it's as much about positioning, Maggie, as anything. It's not that it's so much a better story there. Yes, selectively there are better stories, and I'm a big believer in higher inflation and so on and so forth. But look, at the end of the day, when you look at markets, I know you know this, but whether it's within the U.S. market or even globally, you can reduce stock performance. You look at factors and industries and sectors. The fact of the matter is the U.S. market, depending on how you count it, it's as much as 40 or 45% tech. You look at Europe, I think the Euro stocks is like 6% tech or something like that. So if all you knew that tech was going to do well, you didn't know anything else, you'd say, oh, I should probably be in the US, not in Europe. But if I said to you, and I'm not necessarily predicting this, parts of tech I think will be a disaster, but all you knew was tech is going to go down, that's all you knew, you'd say, I'll take Europe over the US. Thank you very much. So it gets down. So it's nice to talk in macro terms, but and another thing too, it's kind of funny. So when I was cutting my teeth at Fidelity back in the 80s, it was always, oh, international diversification, you got to put your money abroad and blah, blah, blah. And not a whole lot of American investors had that. So it was an easy sale, so to speak. And there are very disparate macro factors at work. So it's one thing if you buy a stock, buy shares in a company in an economy which is near its trough and liquidity is expanding, so you have liquidity in the economy with you, as opposed to you pick an economy where maybe it's overheating, the currency's weakening, the central bank's tightening. So international diversification was a thing, all right? I will tell you, it's not, heretofore, the last few years, last 10, 15 years since GFC basically, there's been no reason to put your money abroad. None, zero, nada, okay? And I think that's changing now.
So it's funny, I'm always find that argument so compelling, and we know that valuations are coming from such a low base compared to some of the U.S. companies. But you just said something so interesting, which is that if you looked at nothing else, and I was just going to tell you that tech was going to go down, that's sort of interesting because you can say Mag 7, or you could say that FANG stocks or the ones we saw run up, but every conference I do, every executive I talk to, like every company's a tech company. And regardless of what's happening in the macro world, I'm going to go to an energy conference, more on that later, folks, next week. And these energy executives are going to talk about the investment they're doing, the technology, the AI they're using to make the grid smarter. It's like everyone's a tech company. So is tech really going down? And in that case, maybe I just rotate and stay in the US and best in class, and I rotate, or I look internationally, but I'm not looking geographically. I'm looking at like tech is still going to be in play because this is how everyone's going to reap the best profits. I never thought of it that way, but
yeah. So I didn't say I believe tech was going to go down. Notice I said if all you knew was tech was going to go down, that would be your thought process. Okay. I'm a very mixed minds about tech. I think it's there are a lot of subsectors. I'm not the world's biggest tech expert. I've made a lot of money shorting tech stocks. I've lost a lot of money shorting tech stocks. Tried every which way. But if you just look at Mag 7 this year, I mean, look, I think Microsoft is up handily this year. Tesla, even with its rally, is down significantly. I was looking at these this morning. Amazon's slightly down. Apple, I think is I don't think I sent you the chart. I think Apple is a walking disaster.
really?
So, oh yeah, I mean,
because of its exposure to China, or
and more than that, there's a really good book out. Name escapes me. I read a review of it and I ordered it. Really good book out on Apple, and the gist of it is it's a brand new book. And I saw this guy a few weeks ago somewhere on the net, and he was talking. It's not just the Captain Obvious bit where they're getting hit by tariffs and they're losing market share in China. Maggie says, "Tell me something I don't know." It was far more interesting than that. And he's basically explaining how China and Apple are really joined at the hip insofar as Apple went into China, they set up all their production stuff. They basically taught the Chinese how to do all this assembly and production. And China basically took all that and not just applied that to all their other manufacturing companies. And so Apple really taught China how to do this. And the other part of it is Apple's in so deep now that, if Trump were to call up Tim Cook tomorrow and say, hey, we're going to put a big tariff on China, why don't you move all your stuff to Malaysia or Thailand? Can't do that. The supply chain is so deep. So they're in deep, and I think they're trapped. And you look. I'm sure I don't know Brent Falk heard the argument before. If you look at the chart looks dreadful, but more important than that, I mean, they're losing market share. They've had de minimis sales growth the last few years. You look at EV to sales, PE. If you're a pure bottom up guy, you would have been short the stock years ago and got your head blown off. And I tried that and I covered it. Okay. But I'm telling you, I think the fundamentals are finally catching up with the stock. And the great thing is, look, if you're an active manager, as you know, Maggie, when you're a professional money manager competing against an index, and one of the problems active managers have had the last few years is you've had these heavyweight stocks have been impossible to beat. If you can't beat them, join them. Well, if I were to say to you, and actually I am going to say this to you, I believe Apple's going to underperform the market materially the next few years for all the aforementioned reasons. So if all you had to do was eliminate that 6% position from the S&P, whatever it is now, and index everything else, you'd beat the market. Now you may laugh at that, but let's face it, the vast majority of active managers can't beat the market. So I don't know. So there's that.
You, George, you hit a nerve because although we often have people with lots of different views in this chat, a lot of people agree with you on Apple, saying that they think Adam said Apple's doing an IBM. Cosmo agree Apple is toast. So yeah, there are a lot of people who are also feeling bearish about Apple. And Nofin said he thinks you're referring to the book Apple in China: The Capture of the World's Greatest Company.
I can't. That might be it.
Yeah, that they ripped it. So, is the only thing that looks attractive right now to you gold? Is that either the safest place to be or the most opportunity? We've seen a run up in it, but do you feel like this has a lot further to go right now?
So again, you know this, Maggie, people kind of have a tendency to talk past each other. It's multiple time frames. If you want the hot take, is gold going to go up this week? If geopolitical risk has calmed down, like, do you really want to buy gold? Okay, probably not. But I remember I had a media appearance a couple months ago, and they wanted a hot take. It was one of the broadcast networks, and I said, the only bull market I can see around gold is there's a bull market in gold bears. Everyone's coming out of the woodwork just because the RSI rolled over and it's broken trend for 72 hours. We're all bearish. But I'm going to steal a line from Jim Cramer. You say about Apple, don't trade it, own it. So gold has kicked the daylights out of the S&P. It's kicked the daylights out of bonds. Be irresponsible for someone to go pull all the money in gold. I get it. But people have no problem putting money in a 60/40 portfolio and putting it into bonds, which have now, I think this is I'm not sure if they may be up on the year now, but prior to this year, they've gone out 4 consecutive years in a row. So the minimum, take some of your money out of bonds and put it into gold or gold equities. I actually think this is a particularly good time for gold equities because of the operating leverage on it. Prices are so high. And also, the fact that oil's rallied a bit the last week or two, but in the general scheme of things, costs are well under control. So if you just think of energy as a proxy for their costs, and you think in the gold price, the sort of the jaws of profitability are opening, and the company's been blowing away numbers. And yeah, I could say it's up, and the talking heads are. I would actually argue to you it's a contrarian position to be uber bullish on gold. If we have time, I can explain why. But
yeah, explain why. And I'm gonna throw in there after you do that too, Matt asking how about the excitement in metals as well? I mean, is this even broader? Silver, palladium, platinum, copper? Does that all feel like short-term trades right now? Or when we're talking about diversifying into, out of the 60/40 and thinking about an asset like gold, should you include other metals as well?
I think that's a very good point. The answer is yes. But Maggie, you have to promise me anyone watching the show is not allowed to come back and complain to you that, oh, you had that guy George Noble on June 23rd and he was wrong. You can come back in a year and tell me in 6 months.
Right. So we always talk about time frames. So these are not short-term trades. These are longer term. The world is changing and you should have more exposure
100%,
to this type of.
And you look at allocations to gold, they're de minimis. I mean, based what's happening, as you know the story, central banks have been buying like crazy. The Chinese have been buying like crazy. The idea that gold is a contrarian long, let me explain this to you. It was one of the made a real impression on me in the early days in the 80s at Fidelity. As a fund manager, Leo Dworsky, passed away a few years ago. And he was a big contrarian investor. And He would always go to the contrarian investment forum up in Vermont. And being a contrarian doesn't mean being a wise guy. You say buy, I say sell. You say black, I say white. No. Let's say that, and I remember this. Well, let's say for the sake of the argument, okay, that we have Maggie Lake Pharmaceuticals, and it's a growth stock, and it's doing pretty well, and the chart looks good. And then they come up with a discovery for a new drug, and the stock goes up 20%. People pile on its momentum. And the taxi drivers are telling, oh, you should buy Maggie Lake Pharmaceuticals. What if it turns out, though, that I really did my homework, and I figured out that the street has not gotten out to the fact the addressable market for this drug is far greater than imagined. It's got other possible applications. So everyone's basing their targets, price targets or whatever, on what they see instead of what possibly might be. And so, for instance, let's take it the case of energy. Okay, if we really got to a choke point where there was, shale was really declining, and shale is starting to decline, by the way. And let's say Gawar, the big Saudi oil field, really did go dry. And Mexico, Pemex, all this stuff, disaster. You could say it's like when they, our Bitcoin friends say you're not bullish enough. Okay, you could imagine the price of oil might go up in a way like far, far beyond what you might say in polite company. All right. So just because someone's bullish on something where everyone's already bullish, take it this way. Okay. Imagine, wind the clock back 10 years ago. Would anybody ever thought about Amazon? Nobody got Amazon, could foresee what Amazon ultimately did. I mean, the stock went from, I think, 100 to 9, adjusted for splits, whatever, in the dot-com bust, and it's gone up, whatever, 100 or 1,000-fold since then, okay? So there's bullish and there's uber bullish. And just to be contrarian doesn't mean you have to be the opposite of what the consensus opinion is. It's a variant perception. So,
yeah, that's a good point. So how come you feel like you're a contrarian on gold, though? Because I feel like...
No, because you know what I think is happening? The reason, because I think what's happening now, people just going along for the ride. And look, you've had, I know, a number of gold bulls on, right? And I don't want to be associated with some of those people, okay? I'm not a tinfoil hat guy, all right? I'm a greedy, opportunistic speculator.
Everyone always says that, by the way, about, especially right now. I don't want to be associated with gold bulls, but I agree with everything they say.
Okay, all right, so you know what? So there. I hate Tesla, okay? I think Tesla's going to crash. Let me tell you why. Okay, I mean, I don't want to talk about consensus stuff, okay? But imagine, okay, we tend to think in gradual terms. Nassim Taleb has spoken about, I think he's got this make-believe place incremental stand or something like that. And you might think something might move 10%, 20%, 30%. But extremist stand, okay, on the tails, that's where the crazies live. So you don't want to be associated with that crowd, right? But it's listen. You asked a question about metals, and broadly speaking, I agree with that. All right, I'm not capable of giving expert opinion on uranium. I haven't studied it enough. Okay, but there are people out there in uranium who are uber crazy. Okay, uber bullish. All right, or take our crypto friends. I'm sure you had people on. In fact, I seem to remember you used to interview or do interviews for a firm that was very big in Bitcoin and crypto. Okay. Just imagine, okay? Imagine what people thought of somebody. I was wrong on Bitcoin for a long time. So I say this with all humility, okay? Most people, I know very few people who thought Bitcoin would do what it did, even the bulls.
Yeah.
So I don't mean to be glib.
So you prefer to be in the incremental crowd, to be trying to look at this and not sort of plant your pole on extreme.
Let me put it another way. Someone asked a question the other day. What would make one less positive on gold? And it was a very good answer. It wasn't my answer. I just try to repeat things that other people say. And the gist of it was, if we had some fiscal rectitude, if we also had interest rates at a level that were mildly appropriate or restrictive, if we had some monetary discipline, if we had some fiscal discipline, okay? Right now, it's nowhere in sight. And as a matter of fact, it looks like we're just heading with a foot of the accelerator right now. So there's really a macro driver behind that. So listen, do I want to? Listen, if gold goes to $5,000 in 3 years, or I'm just making up something. All right, $5,000 in 3 years would be, it's 50% in 3 years. It's 15% a year. All right. I'd be surprised if it didn't do at least that. But do I want to be some? So I don't want to get out there and say, oh, I think gold's going to the moon, and then, oh, George, you were wrong. It only went to 5,000. Right? I'm just saying, it's put it this way. I'm reminded when I was working at Fidelity, I was always taught. I had the real pleasure of working for Peter Lynch, and he was a real stickler on doing the work. And I know I've gotten into trouble. I had an unfortunate experience with an ETF a couple of years ago because I didn't stay focused on doing the work. I got too caught up in narrative. But the point he would make is when you look at a stock or a company, the first time you look at it, you don't know, you're not going to notice everything. You're not going to notice the subtleties and all the nuances. It's always the second time, the third time, the fourth time. You appreciate certain nuances that you didn't on their first inspection. Maybe the CFO answers the question a little bit differently or a different tone of voice. And so can you upgrade the story, or is the story slipping? So let's say you have a retailer where, you think you're modeling in sales at 10% with 20 basis points of margin expansion and gross margin, a little bit of SG&A operating leverage. And it turns out first quarter comes out and it's like, oh, wait a second. Sales are already up 12% instead of 10, and the operating leverage is much bigger than I thought. So maybe my assumptions are too conservative. And so even though the stock is up, it could be a better buy up 20%. If your earnings estimates have gone up 50%, I'm just making an example. If your earnings estimates have gone up 50% and the stock is only up 20%, it's a better buy up 20% than it was the first day you bought it. So it all gets to knowing what you own and paying attention to the fundamentals. And honestly, I mean, I look back a year ago, I wasn't, or 18 months ago, I can't remember exactly when, I wasn't so positive on gold. I missed it. But what made me change? What made me change was when I saw how the fiscal monetary dynamics of this country were changing in a way where, I mean, you look at the outlook for the budget deficit now compared to what people thought 18 months ago. Do a mark to market, it's gotten way worse.
Yeah, well, because there was a lot of hope coming in that they were going to get, Doge was going to find all the savings and that we would, and that seems to have. Emma's asking, I think she's asking it seriously. I don't know. Maybe it's sarcastic. George, don't you think we have monetary discipline right now?
Absolutely not.
I think maybe she's being sarcastic.
I know. So let me ask you, Maggie. I'm sorry. I want to see you smile. I love when you smile. Okay. do you think Anthony Pompliano having money thrown at him? What was it? 750 million or $1 billion for some SPAC crypto thing? That's indicative of tight monetary policy? Or,
listen,
come on.
SPACs are sort of coming back, right? I mean, that's one example, but you've been hearing that bubble up again recently.
And Maggie, I would ask you, I mean, maybe we're not at the top. I don't know. I'm not making a market call here right now. But again, you can read a lot. You can observe a lot by watching, as Yogi also said. All right. Is that a good thing? Yeah, it's a good thing. It shows that speculative juices are flowing. But to the question that Emma asked, are monetary conditions are tight, and I'm guessing it's sarcastic, it certainly tells you no. And, when I look at, we didn't talk about inflation much or anything, but I think inflation's bottom. I think it's picking up. Dollar weakness, oil, the tariffs. The tariffs are either going to hit consumer incomes, they're going to squeeze profit margins. I mean, it's a tax, no matter how you slice it. And I mentioned, I didn't finish, I interrupted myself. I go back to where a few minutes back. Early on, I said we go back to our regularly scheduled programming in terms of where we are. So the tariffs are kind of pushed aside. This Iran thing came and went. So now where are we back to? We're back to a place where we have concerns over spending. And by the way, time is not free here because, it is a funny thing too. I remember a few weeks ago, I was looking this up and people worry about excessive spending, the budget deficit. And I was reminded of Stein's law. I think it was Herb Stein, who was economist under the Nixon's administration. He famously said, I think it was around 1986, that which can't go on will stop. So already in 1986, they were worrying about the budget deficit and the trade deficit.
Yeah.
Okay. But the difference now is, and look, maybe Michael Howe would say, well, it's not debt to GDP, it's debt to liquidity. You know the catechism as well as I do. But if you get to the point where you're not treating, you're dependent on the kindness of strangers. You're not treating them well. You tell them to take their money home, all right? And then you look at where inflation is, and with a long bond at 440, like who in their right mind? Like I get there's forced buyers of bonds to satisfy liabilities, but who in their right mind who's thinking correctly would lend the U.S. government money at 4.4% for 10 years? So, they'll do the SLR, there'll be deregulation, all this stuff. But I don't think, I think money's going to go, I think money will leave the U.S. at the margin. And, but listen, we're here to try to help viewers make money. So whether it's gold or some of the related metals, I think energy still has a shot. I realize that it's not a consensus view, but I follow Mike Rothman very carefully, who's been on Wall Street, and used to be the #1 rated energy analyst at Merrill Lynch. Also had him at our conference. And if you look what's happening in inventories, and you look what's happening in production, it's not just shale in the U.S., but Russia, where they've underinvested for a number of years, that production is not coming back. Mexico, you look around the world, it doesn't look too good. And
that is very different, because a lot of people feel like the world is, or the oil is oversupplied, and the world is swimming in energy.
And Maggie, it takes two to make a market. So that's the beauty of it. Okay. And again, don't listen to my narrative, my hot take, but go look at production and supply. The most important thing that I learned over the years, trying to predict oil prices of fool's errand. Can't do it. It's next to impossible. What really drives the price of oil is supply, not demand. Demand kind of goes up every year, GDP.
Which is funny, because we're in a situation where there has potentially never been more demand for oil.
Demand is hitting an all-time high as we speak.
For energy, I should say, not oil, energy. Energy. Of every single kind you can get your hands on.
Life, GDP, it's energy.
Yeah.
We can't grow without energy. All right. So, and you look at what the Europeans have done. I mean, they've totally shot themselves in the foot. The UK, I forget the percentages, some ungodly percentage of energy now is dependent upon alternatives. So if the wind don't blow and the sun don't shine, as they say, they got a problem. You look at natural gas prices in Europe. And by the way, you want to expand your brain a little bit? Check this one out. So always try to think about like what the non-captain obvious second or third order thinking is. Okay, so the Israel situation didn't really surprise me. It's something for personal reasons I follow very carefully. And I was doing a Twitter space about 10 days ago, and we were doing it in the evening. It was around 8 or 9 p.m. And people broke in. Oh my God, the future's down. Look at this, look at that. And I thought about, we were doing a Tesla bear space actually. And I thought about it, and I said, you know something? This could actually really be bullish. Because big if, the Mideast gets sorted out, which I think is going to happen, that would be a huge positive for the world. It could be a huge area of growth. So now fast forward is, I can't remember where the line comes from. There's what's said and what's not said, and what's often not said is more interesting, right? Yeah. I find it really interesting that the Russians were very quiet about what happened, as were the Chinese. Now, whether it's because they see they couldn't do anything about it, or there was some backroom deal, shocker if that ever happened, okay? Who knows? But like, think about this for a second. What if there's a deal somehow between Russia, the U.S., Europe, where, look, Putin needs an exit ramp. Again, I'm not the second coming of George Friedman. I'm not a geopolitical guy. I'm just hallucinating with you, all right? But they need an off-ramp. What if some type of deal was struck where it's like, okay, everyone make nice, put your guns down. Putin, Europeans will protect you, blah, blah, blah. Putin, you need a market for your energy. You can sell into Europe because Europe needs the energy still, okay? So imagine everyone kind of whole hands does a kumbaya out there. I'm not saying it's going to happen, but, I kind of like this Ukrainian thing is not going to go on forever, all right? And when it does end, that's a huge piece. That's a huge piece dividend. So
yeah,
which
maybe everyone's not looking for yet.
Yeah. So bear porn. We can talk about what can go wrong. As they say, back there's always reason not to buy, but things can also go right. So I don't know. But again, it's a market of stocks.
And Emma pointing out that the net speculative short US dollar positioning, have you looked at it? Lopsided as hell. Fab is also asking an interesting question. Let's leave it here because I want to circle back around to what probably a lot of people have to grapple with, which is stocks and bonds. Is long TLT a contrarian trade at this point? You think it's a terrible one at the very least.
Yeah. I mean, and also I'd say something else. I mean, look, it's never simple. It's never simple. And Maggie, I have violent arguments with myself. Okay, so if I see it,
that's probably a good sign. It's a sign you're sane, actually.
Well, yeah, or I like to. By the way, I do make my own copy. You know, in the infamous words, this is a play on Alan Greenspan. If you're not confused, then you're not paying close enough attention. Okay, it's complicated. All right.
Mm-hmm.
So one of the great lessons I've learned over time is you try to go with trend. Don't be a wise guy, because you know most of the time the crowd, you know, for 60% of the time where the crowd is right. The problem is when you get towards the top, when are they going to bail? When you're at the bottom. Okay, so TLT is a trend. It's a bad idea. Okay, so technically it looks terrible to me. Fundamentally, you know, again, Michael Howell, please call your office. You look at real rates, you look at yield, YCC, you look at the fact that now, you know, if you're a Japanese investor and you want to buy U.S. Treasuries on a hedge basis, it's not profitable. So all the foreigners that were piling in here before, not happening. So like, you want to know how the TLT trade works? Get a recession.
Mm-hmm.
So I would put it to you this way, which I don't think anyone's rooting for. You can have lower inflation, but I think a necessary but not sufficient condition for that is a recession. You can have lower inflation, you can have slower growth, you can have lower bond yields, you can have higher growth, you can have higher corporate profits, you can have higher inflation. You can't have all of them at the same time. They're mutually exclusive. Like, everyone wants their Goldilocks back. That ain't happening. So that's why, you know, yeah, TLT could go up, but the conditions, in my view, and I'm filled with doubt, the conditions, in my view, as to when it would go up would I think it's a world. I think recession is really the most likely. I don't want to say it's the only way, but the most likely way. And where I come from, I look at it this way. I think the chance that year in 10 years at 5.5, we're not talking Weimar type levels, just 5.5 to start the conversation. So you don't throw me out thinking I'm totally crazy. I think it's quite reasonable. And so what's the equity market do in that scenario? So I don't know.
Yeah, that's the rub. George, we could go on and on, but we got to go. We're out of time, but it was so great to have you on the show and catch up with you. We've been talking offline, but it was really fun to be able to do this on the show. So I appreciate your time. Appreciate seeing you.
Thank you, Maggie.
Programming note, folks, as I've been mentioning, I talked about that energy conference. I am going to be there, and I think it's going to be super interesting. Can't wait to report back on all the conversations. I will not be able to do the show on Wednesday because of that, but you can tune in live. They're going to broadcast them. Just go to Reuters Events on LinkedIn or on X and on their website. So Reuters Event, not just Reuters, and you'll be able to track down the energy conference. And then you can catch up and tune into some of the interviews, a bunch of CEOs and execs. And it's really interesting. I've been having prep calls with them, and I think it's going to be kind of fascinating. And we'll touch on this demand that we're talking about and what they're doing to meet it. So appreciate your patience while we miss one, but we'll catch up with you soon. George, thanks again. Thanks to all of you who tuned in. And as always, take care and good luck out there.